Hello friends. In this lesson, we are studying chapter 14 from John Morphy's Technical Analysis of the Financial Markets. The topic is one of the most widely used indicators in technical analysis, MACD, which stands for Moving Average Convergence Divergence. It's a tool that helps traders identify trend direction, momentum, and possible reversal points. What is MACD? MACD is a trend-following momentum indicator developed by Gerald Appel. It shows the relationship between two exponential moving averages, EMAs, of price. It helps traders see both the direction and the strength of a trend. How MACD is constructed? The MACD is calculated using three components. MACD line, the difference between the 12-day EMA and 26-day EMA. Right pointing backhand index formula, MACD is equal to 12-day EMA, 26-day EMA signal line, a 9-day EMA of the MACD line itself. Histogram, the graphical difference between the MACD line and the signal line. These three together form the complete MACD indicator on a chart. Meaning of convergence and divergence. The name moving average convergence divergence comes from how the two moving averages behave. Convergence happens when the EMAs come closer together, showing a weakening trend. Divergence happens when they move apart, showing a strengthening trend. If the MACD and price start moving in opposite directions, that's a sign of a potential trend reversal. Three main MACD trading signals. There are three classic ways traders use MACD to generate signals. Signal line crossovers, when the MACD line crosses above the signal line. Buy signal. When the MACD line crosses below the signal line. Sell signal. Zero line crossovers, when MACD crosses above zero, it indicates a bullish trend. When MACD crosses below zero, it indicates a bearish trend. Price divergence, if the price makes a new high, but MACD does not. Bearish divergence, possible reversal down. If the price makes a new low, but MACD does not. Bullish divergence, possible reversal up. The MACD histogram explained. The MACD histogram was introduced by Thomas Asprey in 1986. It shows the distance between the MACD line and the signal line in the form of bars. When histogram bars are above zero and expanding, momentum is increasing. When bars start shrinking, momentum is decreasing, signaling an early trend slowdown or reversal. The histogram is a leading clue. It often signals change before the actual crossover happens. How traders use MACD in practice. Traders use MACD for multiple purposes. To confirm the direction of the trend, to identify buy and sell opportunities, to measure momentum strength, to detect divergences that warn of possible reversals. It is widely applied in stocks, forex, commodities, and indices. Advantages of MACD. White heavy check mark combines both trend following and momentum features. White heavy check mark works effectively in trending markets. White heavy check mark helps detect momentum changes early. White heavy check mark simple and visual, easy to interpret even for beginners. Limitations of MACD. Warning sign. MACD is a lagging indicator. It reacts after price movement, not before. Warning sign. It can produce false signals in sideways or choppy markets. Warning sign. It does not show overbought or oversold levels like RSI does. Therefore, MACD should be used along with other indicators for confirmation. Combining MACD with other tools. John Morphy suggests combining MACD with RSI, Relative Strength Index, for confirming overbought oversold zones. Moving averages, to check the overall trend direction. Support and resistance levels, to plan entries and exits more accurately. This combination improves reliability and reduces false signals. Conclusion. To conclude, the MACD indicator is a highly effective tool that blends trend analysis with momentum measurement. It shows traders when a trend is starting, strengthening, or weakening, helping them make informed trading decisions. MACD is equal to 12-day EMA, 26-day EMA signal line is equal to 9-day EMA of MACD. Histogram shows the gap between MACD and signal lines. Crossovers and divergence are the main trading signals. Works best when combined with other confirming indicators.